Okay, well, welcome everyone, and thank you for joining me. Today, we're going to be spending about a half an hour-ish. Hopefully, I can get it all wrapped up in about 30 minutes about what's new in Social Security this year and what it might mean for you. We are going to have time for questions, but we're going to hold those until the end. But again, feel free to go ahead and drop those into the Q&A as we go so you don't forget them, and we will get to as many questions as we can with the time that we have remaining today. Before we dive in, always have to share just a quick but important disclosure. This presentation is for education and information only. It is not investment advice, not legal advice or tax advice. I always encourage you to talk with your own financial advisor, your attorney, your CPA about your specific situation. Everyone's circumstances are different, and the right approach for someone else may not be the right approach for you. If you don't have those professionals on your team at this point, or if you're just looking for a second opinion, I will share how we can help before we wrap up our presentation. And let's get started. So quickly, just a little bit about me. My name is Eric Blake. Our firm, Blake Wealth Management, is located in beautiful McKinney, Texas. But we do have clients, and I know there are folks joining us here today from all over the country. As a firm, we focus on helping women over 55 who are divorced, widowed, or maybe navigating retirement on their own. That's our specialty. But don't worry, if this presentation is for everyone. So if there are any men or couples who may be joining us together, I promise you're still going to walk away with practical, valuable information. And I'll say that focus on women comes from my own story. I was raised by a single mother. I spent a lot of time with my grandmother, who was widowed at the age of 62. She's going to be 91 in just a few weeks. And I am actually fortunate enough to still have 5 generations of women in our family, with my granddaughter who just turned 2 just over a month ago. And watching my mother and my grandmother navigate life and money on their own really shaped how I approach retirement planning. And it is why I'm so passionate about helping women feel more confident about their financial future, no matter their background. And so when I say we focus on working with women, we do actually work with couples, but our only ask is that both spouses actively participate in the planning process. So let's walk through our agenda real quick. So we've got here the topics we're going to be touching on. Social Security, once again, paid a cost of living adjustment this year, and we're going to talk about how that cost of living is determined, put it into context, and see what it means for your Social Security benefits going forward. Another number affected by the cost of living adjustment is the earnings test threshold. We'll talk about how much you can earn in 2026 without having benefits withheld if you claim Social Security before your full retirement age. Next, we're going to talk about taxes. We're going to talk about both Social Security payroll taxes and the income taxes you may have to pay on your Social Security benefits. And then for those of you on Medicare, we'll go over the new Part B premiums for 2026 and see why it's not such a straightforward number anymore. And we're also going to cover some important dates to watch in 2026 related to Medicare. We're going to give you an update on the status of the Social Security Trust Fund and discuss some ideas for reforming the system to make it more solvent for the future. We're going to give you an update on some Social Security filing strategies. And then finally, we're going to talk about the repeal of the windfall elimination provision and government pension offset. These were provisions that affected people who worked in jobs that didn't pay into Social Security, like government workers, many teachers, especially here in Texas, where even in my own household, my wife, having been a teacher for 25 years. So let's start with the cost of living adjustments. In October of every year, the Social Security Administration announces a bunch of numbers that are determined by the rate of inflation over the prior 12 months. The most eagerly awaited of those is the cost of living adjustment, or the amount by which Social Security checks are going to be raised for that year. Another number is the new earnings test threshold. And finally, we have the maximum amount of earnings on which Social Security taxes are assessed. So the cost of living adjustment for 2026 was 2.8%. That means if your current benefit is $800, you're getting an extra $22 a month. The higher your benefit is, the higher your COLA is. If your benefit is $4,000, which it could happen if you're a maximum earner and you claimed your benefit at age 70, you could be getting a cost of living adjustment of $112 per month. Now, the annual COLA has varied over the years, and it's averaged about 2.5%. And the Social Security trustees project a 2.4% cost of living adjustment going forward. But actually, we've seen, I think it's important to acknowledge that some of the inflation challenges we've seen over the last few years, as many retirees are still feeling that impact. And we'll also touch on why many people feel it doesn't adequately cover their needs every year. The cost of living adjustment is based on the Consumer Price Index for all urban wage earners. The Consumer Price Index measures the change in a basket of goods and services that a typical urban worker might buy. So it covers things like food and transportation, housing, entertainment, healthcare, and pretty much everything people spend money on. In any case, the cost of living adjustment is announced each year in October, and it takes effect with the Social Security checks you receive starting in January. Even if you haven't started your Social Security yet, let's say maybe you're delaying your benefit until age 70 to get a higher amount, your benefit will be raised by the cost of living adjustment so that when you do claim your benefit, you can be sure that's going to reflect each year's COLA. If you are actually interested in learning more about how the COLA was calculated, you can actually visit this website that you see on your screen here. Now, I want to share an episode I did on the podcast recently where I actually did a deeper dive on understanding the cost of living increase, specifically why many people feel it doesn't adequately cover their needs each year. One potential reason is that if you recall what I just said a minute ago, I mentioned that the COLA was based on what's called CPIW. This is a measurement for workers, not necessarily retirees. So the CPIW may add more weight to things like expenses for commuting back and forth to work. While, of course, many retirees, we think about housing, we think about healthcare expenses playing a much larger role. So I'll pause here just a second in case you'd like to scan that barcode and check out this episode. All right. So that's the first big number change. Next, we're going to talk about the earnings test. The earnings test threshold is affected by the cost of living adjustment as well. And as you probably know, if you're under full retirement age and you work and receive Social Security benefits, part of your benefit may be withheld. They're going to withhold $1 for every $2 you earn over the threshold, which went up to $24,480 this year compared to $23,400 last year. So if you earn less than $24,480, none of your benefits are going to be withheld. But I would also like to just comment that trying to earn less money is not exactly a formula for wealth building. If you are under full retirement age and you have the opportunity and the ability to work, it's probably better to earn as much as you can and delay applying for Social Security. Now, the new threshold for the year you turn full retirement age is up to $65,160, up from $62,160 last year. This higher threshold comes into play if you were receiving Social Security last year and you turn full retirement age in 2026. In the months leading up to your full retirement age month, $1 in benefits will be withheld for every $3 you earn over that $65,160. And then once you turn full retirement age, no benefits will be held no matter how much you earn at that point. So while we're on the earnings test, I'd like to take a moment just to explain the monthly earnings test. And this comes into play the first year that you apply for Social Security benefits. So let's say you're under full retirement age, you file for Social Security this year, and you continue to work. If you earn more than $2,040 in any month, your benefit's going to be withheld. Then next year, you'll be subject to the regular annual earnings test, the $24,480, adjusted for whatever next year's COLA is going to be. Now, technically, if you retire midway through the year, this could also work in your favor. So, for example, if you retire and you start Social Security in July, your earnings from January to June do not count and do not reduce your Social Security benefit. Now, generally, our recommendation is to wait until you stop working to apply for Social Security so you don't have to deal with the earnings test. But there may be exceptions, and we can certainly discuss your individual circumstances. Okay, so having said all that about the cost of living adjustment and the earnings test, I'd like to take a moment just to talk about payroll taxes. The maximum earnings subject to Social Security tax went up to $184,500 from $176,100 last year. So this means that higher earners will pay Social Security taxes on more of their earnings. But remember, the Social Security taxes represent what we hopefully is a good investment in the form of inflation-adjusted income that lasts over your lifetime. But the more earnings you have and the more Social Security taxes you pay, ideally, the higher your benefit's going to be. And then remember, as long as you're working and paying into Social Security, your benefit will continue to be adjusted. So if you improve your earnings record, your benefits may go up, even if you've already started Social Security or started collecting Social Security. And I think that's actually something that surprises people. And again, if you're interested in seeing how the Social Security Administration calculates this cap, you can also go to this website as well. Now, the Social Security tax rate did not change. So as an employee, you still pay 6.2% in payroll taxes on your earnings. Your employer will pay the same amount. If you're self-employed, you actually pay both parts, the total of 12.4%. The Medicare tax also did not change. The employee's portion is 1.45% on all earnings. Self-employed people pay both sides, or 2.9%. So here's just some basic math on how this works. If you earn the maximum $184,500 in 2026, you will pay $11,439 in Social Security taxes. If you're self-employed, you'll pay both employees and employer share of that tax, or $22,878, and the Medicare tax will be on top of that. So that takes care of payroll taxes, or the taxes collected to fund Social Security and Medicare. Now we're going to talk a little bit about the taxes on your actual benefits, which is going to be a little bit different. So ever since 1984, Social Security benefits have been subject to some level of taxation depending on your other income. This table shows the taxation of Social Security benefits based on the various income levels. And income in this case means provisional income, which includes adjusted gross income plus 1/2 of the Social Security benefit plus any tax-exempt interest. So if your provisional income is under $32,000 for a married couple, no benefits are subject to tax. If provisional income is between $32,000 and $44,000, up to 50% of a married couple's benefits are subject to tax. And if provisional income is over $44,000, up to 85% of your benefits are subject to tax. And the thresholds for single individuals are $25,000 and $34,000. And in the case of married filing separately, if there's somebody out there that might be in this circumstance, if you're filing separately, living with a spouse, 85% of your Social Security is taxable regardless of income level. Now, something to note, these income thresholds were never adjusted for inflation. So that means more and more people have been required to pay taxes on their Social Security benefits. And the important thing to remember here is that up to 85% of your Social Security benefits may be subject to tax, again, depending on how much other income that you have. Now, it's also important to note here, there's still some confusion around this. The new tax law did not eliminate taxation on Social Security benefits. The new age 65 plus deduction simply reduced the number of individuals that have to pay tax on their Social Security. The taxation of Social Security benefits did not change. Now, we're not going to directly discuss the new tax law as part of this presentation, but I'm more than happy to take questions afterwards. So it's a good idea to plan for Social Security taxes ahead of time. So those of you who are still well in advance of your RMD age, for example, you might want to start drawing down some of those assets so the RMDs don't force you into a higher tax bracket for Social Security. Now, the operative word there is might. Beating the Social Security tax might not be worth it depending on other tax considerations, so you definitely want to consult with a qualified tax professional. You might also want to think about converting to a Roth IRA, which generates tax-free income. Again, please consult your tax specialist before doing this. Now, we'll touch on something real quick here you remember with the provisional income, I talked about you have to actually add back in tax-exempt interest. So that might be municipal bonds, municipal tax-free money markets. You have to add that back in to determine your provisional income. Roth IRA distributions are tax-free, but they don't get added into your provisional income calculations. That's an important fact to be aware of. Of course, the other way to pay less in Social Security less tax on your Social Security is to delay it, reducing the number of years your income is subject to tax. Now, this is not the main reason to delay benefits. Delaying Social Security benefits is mostly advantageous because of the higher benefits you're going to get by delaying, but it actually can also help with your tax situation as well. Now, the law recently changed regarding RMDs as well, so you want to be aware of this. You may remember that it used to be that you had to start taking minimum distributions from your IRA beginning at age 70 and a half. And then a couple of years ago, the age was raised to 72, and now the most recent legislation raised it to 73 starting in 2025. So that's one of the things you want to make sure, again, you're talking with your financial advisor if you have specific questions around that. And if you're born in 1960 or later, it's actually age 75. And the thing about RMDs is you may have had your income tax, you may have your tax situation all figured out, and then all of a sudden you have to start taking these required distributions from your IRA accounts. And if you don't plan ahead, these RMDs might actually bump you not only to a higher tax bracket, it might actually end up forcing you to pay a higher rate of tax on your Social Security benefits as well. Again, I'll show one more podcast episode if you'd like to take a deeper dive into how Social Security is taxed and strategies around that, including the impact of the new tax law. I'll pause here again for just a second in case you'd like to scan that barcode. All right, so let's move on to Medicare premiums. The base Part B Medicare premium is now $202.90 per month. That's up from $185 last year. However, something to be aware of, some people actually pay more due to income-related monthly adjustment amount, or what's called IRMAA, which I'll talk about here in just a minute. If you are on Social Security and you have your Medicare Part B premium deducted from your Social Security benefit, there is a hold harmless provision that keeps your check from going down if the Social Security cost of living adjustment doesn't cover the rise in the Part B premium. This year, the Social Security cost of living adjustment was 2.8%, while the Part B premium went up nearly 10%. But in most cases, the dollar amount of the cost of living adjustment more than covered the increase in premiums, so the hold harmless provision does not apply. Now, the issue that will be affecting more people is the income-related monthly adjustment amount, or IRMAA, being applied to their Medicare premiums. Now, basically what IRMAA is an extra premium you must pay if your modified adjusted gross income exceeds certain thresholds. In 2026, the first threshold is $109,000 if you're a single and married filing separately, up from $106,000 last year. For married couples, the first threshold is $218,000, up from $212,000. Now, MAGI for this purpose is adjusted gross income, again, plus tax-exempt interest. That's an important fact. So when you think about tax-exempt interest, most people think federally tax-free, but it might actually impact your tax situation when you have to add it back in, either for provisional income or, in this case, determining whether you might have to pay extra Medicare premiums. Your premium each year is based on the tax return you filed 2 years prior. So if you're on Medicare, your 2026 premium is based on the income you reported in 2024. But if your income has changed due to specific life-changing events, such as retirement, you can actually appeal that. In other words, if you reported higher income in 2024 and you've since retired, you can appeal that higher premium. Now, please note that the one-time capital gains is not grounds for appeal. I've seen this a number of times when people might sell a house, they might sell an investment property, a piece of real estate, which is triggering capital gains. But that's not an exception that you can use to file an appeal. So in other words, if your 2024 tax return shows a high income because you sold an asset in that year, you'll have to pay that higher premium in 2026. But if your income has gone back down in 2025, then your 2027 premium will be lower. And this is the table. This is the Part B and Part D premiums that actually shows you the table of the different thresholds. So if you're single and your income is under $109,000, or if you're married and your income is under $218,000, you'll just pay the regular Part B premium of $202.90. There will be no income-related adjustment. If your income falls into one of these other tiers, that's where you're going to pay that income-related adjustment on top of the base premium. So for example, if you're in that second tier, you'll pay an extra $81.20 for Part B and $14.50 for Part D on top of the regular premium. Keep in mind that this is for a single person. So if you're a couple, you actually have to double that. And keep in mind, these premiums also that we're looking at here, they do not include premiums for drug plans, Medicare supplement plans, or Medicare Advantage plans. This is only for Medicare. Whether you're already on Medicare, or you're getting ready to start, here's some important dates you want to pay attention to. The Medicare Advantage disenrollment period is from January 1st to March 31st. This is the time you can get out of Medicare Advantage plans and go back to original Medicare, but do make sure you get supplemental coverage. If you're going back to original Medicare, you want to get the gaps covered with a Medigap policy. But unless you're applying during your Medicare open enrollment period, which is generally that first 6 months after enrolling in Part B, they don't have to take you. So if you have health issues and you drop your Medicare Advantage plan, you may not be able to get a Medigap policy. So be sure that you get that lined up first if you're thinking about dropping Medicare Advantage plans. January 1 through March 31 is also Medicare general enrollment period. This is for people who never signed up for Medicare when they turned 65, or maybe they left when they left their employer plan. So if you do sign up for Medicare during this time, your coverage will start the month after enrollment. The annual enrollment period for people on Medicare is October 15th to December 7th. In September, you're going to receive information from your current plan about their offerings for the next year. And you want to pay attention to this. Your premiums might be going up, your coverage might change, or there might be some new plans in your area. If you currently have a Medicare Advantage plan, you'll want to see how it's going to change for the next year. If you have original Medicare, you'll want to see how your drug plan will change for the next year. Then you'll want to look at other plans offered in your area to see if any of them might be any better. If so, you want to contact the new plan by December 7th. If you do nothing, you'll be re-enrolled in your current plan for another year. And although you'll have another chance to switch Medicare Advantage plans during disenrollment period that we just talked about, it's much more efficient to make your choice during this annual enrollment period and stay in your new plan for the calendar year. Actually, if you have questions about Medicare, please let us know. We do not sell Medicare, but we have some amazing professionals in our network. All right, so let's talk about the future of Social Security. Of course, Social Security was designed as a pay-as-you-go system. Payroll taxes from current workers go into a trust fund and are immediately paid out to current retirees. Because baby boomers have been in their peak earnings years, the trust fund has accumulated more than needed for current benefits. Right now, the trust fund holds about $2.7 trillion, which is invested in special issue treasury securities. But as baby boomers continue retiring, these trust fund assets will gradually be drawn down. So just for clarification, the trustees report comes out around June of each year, which is why we have 2024 numbers here. So over the next 75 years, costs will begin to exceed income. There are enough reserves that the system will be able to pay 100% of promised benefits until 2034. After that, if nothing is done to reform the system, income will be sufficient to cover about 81% of promised benefits. So although the Social Security system is not in imminent danger, most people agree that the earlier the reforms are instituted, the less painful they're going to be on everyone. It's really just a math problem that involves an increase in revenues, a cut in benefits, or a combination of these two. So here are just a few of the ideas that have been proposed. One would be increasing the maximum earnings subject to Social Security tax. Currently, $184,500 in earnings are subject to that 6.2% tax paid by you and your employer. One way to shore up the system would be to raise that cap or maybe even eliminate it altogether. Another reform proposal calls for raising the full retirement age. Currently, full retirement age is 66 for people born between 1943 and 1954. It's 67 now for people born in 1960 or later. An argument in favor of raising the retirement age is that people are living longer. An argument against that is that people whose occupations involve hard physical labor may not really be able to work until age 70. And then another reform proposal would change the benefit formula so that future increases would happen at a slower pace. This would affect the benefits of future retirees primarily. And then some are talking about changing the formula for cost of living adjustments. This could give retirees smaller benefit increases going forward, although the changes are expected to be minimal. Given there are lots of ways the Social Security system can be reformed, is Congress likely to address this issue this year? Probably not. Other issues, of course, are taking priority. And because of that $2.8 trillion trust fund, benefits are not immediately in danger. The last time Congress made major changes to the Social Security system in 1983, the trust fund was just within a few months of running out of money. And theoretically, Congress has until 2034 before they have to worry about that actually happening again. So I want to talk a little bit about some of the Social Security filing strategies, even though these may not affect all of you, especially those who have already started taking Social Security. I think it's important to be aware of these. Some of you may have heard the strategy called file and suspend. Following the Social Security law changes in 2015, this strategy is no longer available. The other strategy, the claim more later, is also no longer available. We only mention this because people still ask about them. The rule is now that you cannot take a spousal benefit if your own benefit is higher. Although some of these spousal loopholes have been closed, it is still possible for a lower earning spouse to receive 50% of the higher earning spouse's PIA if the lower earning spouse's own benefit is lower. But please note that if a lower earning spouse is claiming the spousal benefit before full retirement age, the spousal benefit will be less than 50%. Also, the other spouse must be taking their benefit, and if the higher earning spouse's benefit includes delayed credits by claiming after full retirement age, the spousal benefit will not include these delayed credits. We'd be glad to run a spousal planning analysis for you to show you when the best time for each of you to claim from your respective benefits would be, and you can definitely check with us after this if you're interested. All right, about to wrap it up. So on January 5th, 2025, the president signed into law the Social Security Fairness Act, which passed by Congress with bipartisan support. This law repealed the windfall elimination provision and the government pension offset for certain teachers, police officers, firefighters, other government workers who did not have Social Security taxes deducted from their paychecks. In total, this impacted very low percentage of individuals. So I'm not going to spend a whole lot of time here. But I think what is important to know is that if you think you could be impacted because you worked in a position not covered by Social Security, or maybe a spouse did, you want to know if you're eligible for additional benefits, or maybe the benefits that you never thought you were eligible for. As I mentioned, we're actually here in Texas, and most teachers have been impacted by this law in some way, including my wife, who I mentioned earlier is a teacher for 25 years. Also important to know that this law was retroactive to January 2024. So again, if you've been affected by the WEP or the GPO, please reach out to me or your current financial advisor to discuss your situation. In some cases, there may not be anything you need to do, but in others, you actually may need to take some action there to make sure you're getting the benefits you deserve. And we can definitely help you figure that out. All right, so as we get ready to wrap up and get to your questions, as a thank you for joining us for this presentation, I want to offer a few resources to help you take the next step in your retirement planning. First thing is we're going to offering a complimentary Social Security checkup. In working with clients on Social Security, we found that sometimes people just miss out on benefits because they didn't know they could claim them. And here are just a couple of examples. Here's a situation that's not too terribly uncommon. A married couple who never added on her spousal benefit after her husband filed. For example, in doing a Social Security checkup, we would look to see if that lower earning spouse's benefit is significantly lower than the 50% of the higher earning spouse's benefit. And this could suggest that the lower earning spouse filed first, claimed her own smaller benefit, then sometime later her husband filed for his benefit. This would entitle her to a spousal benefit, which would be added to her own smaller benefit. But she would have to apply for the spousal benefits, which she didn't know to do. And our Social Security checkup reveals these types of strategies. Another one is a divorced person who didn't know she could claim a spousal benefit off her ex-spouse. Now, not everyone could do this because your own benefit must be less than half of your ex's. If you've been working, your own benefit may exceed your divorced spouse benefit, but it's always good to check on this. Our Social Security checkups can help divorced people find out if they're receiving all the benefits they're entitled to. Here's another one, a divorced person whose ex-spouse has died. You know, sometimes ex-spouses don't always keep track of each other. But if a person was married for over 10 years to an ex-spouse who has died, she may be able to get a survivor benefit based on the ex-spouse's earnings record, which is maybe higher than her own benefit. And these are not limited to women, of course. Social Security is gender neutral, so divorced men can also claim benefits based on an ex-spouse's record. So if you or anyone you know would like a Social Security checkup, we may be able to help you identify some of these possible benefits and explore claiming strategies. Most importantly, just see how Social Security fits into the rest of your retirement income plan. So as you exit out of our presentation, you're going to be directed to a scheduling page should you choose to take us up on this offer. And if not, no worries at all. Also, as a thank you for attending the entire presentation and a follow-up email, we're going to be sharing our 2026 Social Security Quick Reference Guide. This is a 2-page guide, which will include all the key numbers we discussed during this presentation, as well as several other key numbers that may help you in planning your Social Security and retirement strategy. Last thing before we get to your questions, one way we help our clients and our broader community stay informed is through the Simply Retirement podcast. We talk about everything from Social Security timing to taxes to real life decisions that women like you are making every day. On the screen, again, you'll see a QR code that takes you directly to the podcast website. Feel free to scan that now or after the session. Again, it's a great way to keep learning at your own pace and on your own time. All right, so this concludes the Social Security presentation update. We'll be updating this presentation as things change, let you know when the next one is scheduled. I think the one thing I wanted you to take away from this is Social Security is too important for guesswork, and we would love the opportunity to help you protect your nest egg and maximize your retirement income. And we'll spend the rest of our time. We got done about 32 minutes, not too bad. We'll take the rest of the time to answer your questions. Just a second to get to that. First thing I'm going to do, I did get a few questions. So don't see anything coming through the Q&A box yet. So I'm going to get to the couple that we had that came through in advance first. So this one, I'm not going to share the person who posted this, but I thought it'd be worth sharing. It was a comment that was made when registering. I don't even know what question to ask. Just trying to learn as much as I possibly can in preparation for a divorce after 25 years of marriage, being a mother without a career, trying to be hopeful and not too terrified of what is ahead. Thank you. To this person, I would just say you're taking the right steps. keep working, looking at opportunities for educating yourself, keep asking questions. I know how difficult this situation can be, but just keep working on getting more information is going to be the key, and reaching out to the right people that can help you navigate this decision. And I'll tell you, we've got a huge number of resources, contacts, professionals in our network. If you need anything, please don't hesitate to reach out, whether that's financial coaching, divorce coaching, whatever it might be. Don't hesitate to reach out to us. We're more than happy to get you connected to the right people. Is it advisable to consider moving funds from private investments to retirement accounts when you're already past retirement age? I'm not sure if the person that asked this question is with us or not. I may need some clarity on what you're referring to related to private investments. Whether that means a 401k plan that's still with the 401k or with a previous employer. I'm not sure about that. So it's hard to, I can't really answer that without saying for sure what that exactly means, moving from private investments to retirement accounts, unless maybe it's bank accounts. You can't really move money into retirement accounts once unless you're still working. So it definitely needs some more clarity on what exactly that means. Next question, really good question here. So how can retirees reduce the tax impact on their Social Security income? And do Roth withdrawals affect Social Security taxation? Number one, the best thing you could do as far as taxation on Social Security is advanced planning. Looking at when am I going to start Social Security? What is my RMD age? What are my projected RMD amounts? How much am I going to be taking from retirement accounts? That's really going to be the thing you want to start with. The second part to then, do Roth withdrawals affect Social Security taxation? They do not. That's a huge advantage that Roth accounts have. So you're talking about, we talked about the provisional income calculations. We talked about the IRMAA thresholds. When you're determining your provisional income, you have to add back in tax-exempt interest. Tax-exempt are supposed to be federally tax-free, but you have to add them back in, which might actually increase how much of the tax you're having to pay on your Social Security benefit. Roth withdrawals, assuming they are tax-free, assuming you meet all the guidelines, and do not increase your provisional income or your IRMAA thresholds. So we're talking tax-free. So that might be where you start thinking about things like Roth conversions or the timing of when you start drawing from your different types of accounts. All right, so we did get a question. So hopefully I will go ahead and read. I won't say who's saying this, but not a question, but I thank you kindly for your help getting me set up with survivor benefits. I also want to thank you for encouraging Leah for all her hours of help she's given me after her dad passed away. She's been great. Absolutely. I'm happy to help. I'm glad you joined us, and I'm glad we were able to get you on the right path. All right, so we got plenty of time for more questions. Anything else that I can do? While we're waiting on any additional questions, so I will touch on this real quick, so I think it is helpful. Talking about the new tax law, the One Big Beautiful Bill Act, and the impact on Social Security taxation. So bottom line is you've got now this new age 65 plus deduction. So you have to be age 65 by the end of the year in order to qualify for a $6,000 per individual deduction. And this is on top of your standard deduction or itemized deductions. So it can be a huge advantage, but that was basically the trade-off. So from a legal perspective, they couldn't actually change the way Social Security was taxed. So this was kind of the next best thing, was to create an additional $6,000 deduction available to those who are 65 or older. Now, it's also important to be aware that this deduction expires at the end of 2028. It is not a permanent deduction. A lot of the new tax rates that we've been under for quite a while, those were made quote unquote permanent. But some of these new provisions, the deduction for the age 65 plus deduction and a few of the other deductions, are not permanent. They're only going to be in place until the end of 2028. Okay, so moving money from non-retirement accounts to retirement accounts while still working in retirement, is it possible or wise? It's possible only based on whether or not you have earned income. So I'll give you a couple of examples here. So if you've got money, let's say you've got money in just a brokerage account or maybe just a savings account, and you want to transition money to a retirement account, the only way you can make a contribution is if you have earned income. So for example, in 2026, the maximum amount you can put into an IRA or to a Roth IRA is $8,600 if you're over 50. So it's $7,500, the basic contribution maximum, plus $1,100 age 50 catch up. So up to $8,600. To put money into an IRA, you would have to have at least $8,600 in income to put the full amount into your IRA or to your Roth. Now, if you have $5,000 in income, maybe you're doing some contract stuff or just some part-time stuff. If you have $5,000 in income, you can put up to $5,000 into your Roth or to your IRA, depending on which one is best for you. And that was another episode we did a couple of weeks ago on the 2026 contribution limits and how to think about prioritizing which accounts you might want to fund if you can't fund all of them. So whether we're talking, getting a match on a 401k, or should I contribute to a traditional IRA or a Roth IRA? So that was something that you might go back and check out there as well. But that's the key is in order to get money into a retirement account from a non-retirement account, you're really talking about making a contribution, which requires earned income. And it can make sense depending on the circumstances. Now, again, be careful about saying, well, if I'm working in retirement, I'm putting money into an IRA and then having to turn around and immediately take it out because of required distributions. So that was part of the Secure Act law change. This is an interesting change they made. So if you're over 73, you're above your RMD age. If you're working, you still have to take your RMD, but you might be able to kind of offset it by making an IRA contribution on the other side. So as long as you have earned income, you can contribute to an IRA, whether you're 65, 75, or 85. Now, again, if you're above your required beginning date for minimum distributions, you still got to take that RMD out. So that's where you'd want to be careful about which type of account does it make sense to contribute to. If I put money into traditional IRA and I'm above my RMD age, I might have to take some of that back out, and that would be taxable, versus maybe saying, hey, if I've got earned income, I might fund my Roth account, which is tax-free. And that's where you got to start looking at your tax bracket and which is going to be the most tax-effective solution for your situation. And very much, I thank you for saying that you listen to all the podcast episodes. It's very much appreciated. I'm glad you're tuning in. All right, let's see. If lower earning spouse takes Social Security before full retirement age and the higher earning spouse waits until full retirement age to take Social Security, is there a reduction in the spousal step up? That's a depends question. So your benefit is going to be reduced because you started early. The next step is dependent on when you file for that spousal benefit. The only way you get a maximum 50% spousal benefit is by waiting until your full retirement age. So that's the key. So your benefit is going to be permanently reduced if you file early, but your extra catch up. So let me see if I can give you maybe an example here. Let's say the higher earning spouse, their benefit's $3,000 and the husband waits till full retirement age to file. But you filed at 62 and your benefit is $1,000. And that's reduced from what maybe it would have been $1,500 or so on its, or maybe $1,600 or so. Let's see, make sure I'm doing my math. So probably like $1,400. So as long as you wait until full retirement age yourself to file for that spousal catch-up, you can get the full true-up amount, we'll call it. So your benefit is still $1,000, but you'll be able to get up to that extra $500. So it's still reduced from what it could have been. But that's where it really depends on you. To get the maximum 50%, you have to also wait until your full retirement age. Not sure how good of a job I did on describing that. Excellent. Glad it helped. And I will say again, a lot of these are podcast episodes. We've done an episode specifically on spousal benefits that might be helpful in those situations. Because really, that's the full retirement age piece is the biggest thing. With spousal benefits specifically, the higher earning spouse must have filed. That's a key. And that's the other part for the spousal benefit. It doesn't necessarily matter when the higher earners filed. They could actually file early themselves, but as long as the lower earning spouse waits until full retirement age, you could still get up to 50%. So that's an interesting piece there. Also, in case there's people that are divorced that might be listening, if you potentially are eligible for an ex-spousal benefit, 50% of an ex-spouse's benefit or of the higher earning ex-spouse, they do not have to have filed for their own benefit for you to file for an ex-spousal benefit. That's a difference between spousal and ex-spousal. The only thing that has to have happened is that you must be at least age 62 and the divorce must have happened at least 2 years ago. Now, whether you should, that's a whole nother question, but the ability to do so is not dependent on the ex-spouse having filed. So that's a key from a planning perspective. That's a key difference. All right, we got plenty of time for more questions. Anything else that's on anybody's mind? Let's see. I'm trying to think of any other specific things related to that new tax law that might be helpful. I didn't really touch on this I only briefly touched on the new tax law in the presentation, but I think it's also important when we're talking about things like RMDs and retirement distributions and Social Security. There is an income threshold for that for that age 65 plus deduction as well that you want to be aware of. So, for example, as a single individual, if your adjusted gross income exceeds 75,000, that $6,000 starts getting reduced. So if your income is too high, whatever the reason might be, you had to take an RMD, you sold something, whatever it might be. Once you go above $75,000, that's when your age 65 plus deduction, that $6,000 will start getting gradually reduced until it reaches, I believe it's 150,000, where it's eliminated altogether. So if your income is too high, you might not get that age 65 plus deduction. So again, that's where the planning really becomes important. And along those same lines, as you're thinking about the next few years, this really does also present an opportunity for some tax planning. Thinking about if I'm getting that age 65 deduction of $6,000, does that create some flexibility for Roth conversions or for recognizing gains of some sort? So that's really where income planning over these next few years really becomes valuable in understanding what your potential opportunities are. Okay, let's see. We've got another question. So if owning property in 2 states, where would you recommend getting financial advisor, or does their location matter? Just want to make sure they know state tax laws. I think number one, I would ask that exact question. How familiar you are with the state tax laws? I know for our situation, we have clients all over the country. I think so. One thing I think you have to be comfortable with is, do I want to meet this advisor in person, or am I comfortable with Zoom or some other virtual method of meeting with them? We have a lot of clients we meet by Zoom, a few that just do phone that's just a preference. But a lot of our clients are around the country. We do all of our meetings by Zoom, and we always meet at least twice a year. And I would say, that would be a great question to ask. And how would you keep up with, or how would you understand what the state tax laws in my specific situation? Now, I would also say, while we're on the topic, if you own property in 2 states, you probably need to make sure you've updated your estate plan, which is that's a sidebar, but that can be really tricky as well. So that would be another question I would throw out there. If you're interviewing financial advisors, what happens if I've got property in 2 states, and are they bringing up the challenges that you could face from an estate planning perspective? But I think ultimately the real answer to your question is, find somebody you feel comfortable with, ask the right questions. Again, I wish this episode was live, but it goes live next week on the 7 questions that every woman should ask a financial advisor before hiring them. That's going to be our episode that goes live next week. Tune into that episode. Hopefully you'll pick up some information, but I think it's just asking the right questions. Geography these days doesn't matter as much, but it's more, who do I feel comfortable with? Who do I have confidence in that's going to be providing me and walking along this path with me, providing advice, providing recommendations, being there when I need help. If you feel like you would be comfortable working with somebody in some other area of the country, that's really the big question, is, do I feel comfortable working through Zoom or using Zoom as the meeting location? Or what, Google Meets, or there's all kinds of Microsoft Teams, there's all kinds of virtual platforms. But I think that's the big question. Do you feel comfortable working with an advisor in that capacity? So we got about 10 minutes left. What else can I throw in here that might trigger some questions? I think we'll talk about here one. So thinking about different states, one of the things that's really key is understanding the new SALT cap increase. So part of the new tax law was the state and local tax deduction increase from $10,000 up to $40,000. That might be something to think about. That might be a great question to ask as well, is looking at the properties that you have, depending on whether it's rental property or personal property, is what impact might this new SALT increase have on my tax situation? Is it going to be a position of, so years and years, basically since the Tax Cuts and Jobs Act in 2017, about 90% of people took the standard deduction. Part of that was because there was a cap on how much you could deduct in property taxes, state income taxes. That might change for a number of people now, especially when we're talking about property taxes if you've got property in 2 different states. So how might that impact your planning? And is the advisor that you're interviewing, are they aware of these different circumstances? Unfortunately, a lot of advisors, they're not proactive tax planning, whether it's because their firm doesn't allow it or it's not something they do. They're more focused on investments. So I mean, to me, tax planning is critical. And those are the types of questions you want to ask if you're evaluating financial advisors, asking these types of questions. How do you stay up to date on tax law? Are you going to help me minimize taxes? And what we talk about minimizing lifetime tax liability quite a bit. And so, well, what am I going to do this year, the next 5 years, the next 10 years to help manage my tax bill or hopefully reduce it based on whatever the guidelines and rules and laws are at the time? How can we utilize that to your advantage? The other thing, and just again, just kind of things popping in my head. What tax plan, if they, number one, you ask the advisors, do they do tax planning? That would be a great question first. Number two, what types of tools do you use for tax planning? So we use a tool that actually factors in state income taxes where we can actually model that out and say, well, what impact is this going to have? Not only just the federal level, looking at the federal tax projections but incorporating the specific state as well, where we can look at the specific state tax laws and help you understand where some of the opportunities may be there. All right, we got about 7 minutes here. Any other questions? Double check, make sure I didn't miss any. You're very welcome. Thank you so much for joining. Hopefully, I'm definitely glad this was helpful. That's what we're here for. All right, we'll tell you what. So I'll give it another minute or so, but I will follow up with an email. I'm going to send, number one, we'll send a link to the complimentary Social Security planning session if you'd be interested in that. We'll share the PDF file, the quick reference, Social Security quick reference guide for 2026. But actually, when you get that email, don't hesitate to reply back if you come up with additional questions. We will try to get this recording out as soon as reasonably possible. Again, got to get it through our compliance folks, all that good stuff. We'll get it on, hopefully get it on YouTube, and then also be able to share it in our weekly email newsletter. But yeah, so hopefully, again, thank you so much for joining. Hopefully you found this very helpful. But again, I'm available. Shoot me any questions by email, and hopefully we can stay in touch either through the newsletter, the podcast, or possibly through a Social Security planning session together. So have a great rest of your day. Have a great weekend. And again, thank you so much for joining.